on January 1st, 2026, while COMEX showed silver at $72 per ounce. Physical dealers in Dubai and Tokyo were selling it for $130, an 80% premium, the largest disconnect in precious metals history. And 3 weeks later, silver hit $95. While Trump's Greenland tariff war sent markets into panic, this isn't a rally. This is a system breaking in real time. January 1st, 2026. While most Americans were watching fireworks and making resolutions, something unprecedented was happening in the global silver market. COMEX, the largest silver exchange in the world, showed silver trading at $72 per ounce. But in Dubai, in Tokyo, in physical bullion markets across Asia, dealers were selling the same ounce of silver for $130, an 80% premium over the official spot price. This isn't normal market behavior. Gold occasionally sees 5% to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regions. But an 80% systematic decoupling between paper and physical prices across an entire hemisphere, that has never happened before in modern financial markets. In Shanghai, the premium was running $8 per ounce above COMEX. Foreign suppliers were being offered these premiums just to secure metal. Indian buyers offering $5 premiums. On Japan's Mercari platform, secondary market premiums hit 60%. And here's what makes this particularly significant. For decades, global silver pricing has been controlled by paper markets, COMEX in New York, the London Bullion Market Association. These exchanges trade futures contracts, derivatives, paper promises of silver delivery, and the volume of these paper contracts completely dwarfs the actual physical metal in existence. The current ratio, 356 to 1. That means for every single ounce of physical silver, there are 356 ounces worth of paper claims circulating in global markets. This system has worked for years because of one simple assumption. Nobody would ask for physical delivery all at once, but something changed on January 1st. China, the world's largest silver refiner, implemented new export controls. Silver was reclassified from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver, and those companies now control approximately 121 million ounces of annual exports, representing 60% to 70% of refined silver traded globally. This isn't about trade policy, it's about control. And when you control 70% of the world's physical silver supply, you control the price. What happened next revealed just how fragile the paper market really is. Because when a market splits this violently between paper contracts and physical delivery, one of two things is happening. Either the paper price is fake, or there's no actual silver backing those contracts. The evidence suggests both. The first week of January 2026, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. In 7 days, 26% of COMEX's registered inventory disappeared. To put this in perspective, COMEX registered inventories have already fallen 70% since 2020, and now, in a single week, another quarter of what remained was pulled from the exchange. Who was taking delivery? According to CME Group delivery reports, JP Morgan and Citibank were aggressively positioning to take maximum physical delivery. Most futures traders close or roll their positions before expiration to avoid the hassle of physical handling. But here, over 1,000 contracts in a single day, and thousands more throughout the month, went to actual delivery. This represents a complete behavioral shift from short and hope for lower to take it all in physical, and the market's stress signals became impossible to ignore. Silver lease rates, the cost to borrow physical silver, exploded from a typical 0.3% to 0.5% annual rate to 8%, a 16 times increase. When someone is willing to pay 8% annualized just to borrow silver for short-term delivery, that sends a clear message. Physical supply and demand are severely out of balance. Under normal conditions, no rational borrower would accept such an expensive cost. But when having no silver is more lethal than silver being too expensive, you pay what you must. The exchanges responded exactly as they did in 1980, and again in 2011. They pulled the kill switch. On January 7th, the CME Group announced it was raising silver maintenance margins to $32,500, a 47% increase, described as a standard response to volatility. Translation: we're changing the rules because we're losing. Margin hikes force mass liquidation. Retail traders who were long on silver, holding contracts with leverage, suddenly needed to post nearly 50% more collateral. Those who couldn't were forced to sell. The paper price dropped 15% in a single week, falling below $72 in intraday trading. Headlines screamed silver crash, but the physical reality was diametrically opposed. While paper silver was being hammered down, physical premiums in Shanghai remained elevated at $8 per ounce. Dubai and Tokyo dealers still couldn't source metal below triple-digit prices. The consequence? 44 silver trading firms in Rajkot, India, declared insolvency. Combined liabilities close to $425 million. These weren't small retail traders, and these were established firms who bet on the paper market, who held futures contracts instead of physical bars. When the CME moved the goalpost with margin requirements, they were wiped out in hours. This is what happens when you confuse a paper promise with an actual asset. And Wall Street's largest banks, the ones who have been telling investors for years that silver would average $32 per ounce, they just missed a 147% rally. Citigroup recently stated that silver looks fundamentally overvalued above $70, and they see it averaging $70 for 2026. Translation: please stop buying so we can cover our shorts. They missed the bus at 30. Now they want retail investors to get off the bus at 70 so they can finally get a seat. But the physical buyers, industrial giants, China, India, they weren't listening to Citigroup. Every time the paper price dropped to $70, they backed up the truck and bought everything that wasn't bolted down. January 17th, 2026, President Trump announced a tiered punitive tariff structure targeting 8 European nations, dubbed the Greenland 8: Denmark, Norway, Germany, United Kingdom, France, Netherlands, Sweden, Finland. The demand? A complete and total purchase agreement for Greenland, citing strategic importance for national security and vast untapped mineral reserves. The timeline? An initial 10% tariff on all imported goods, effective February 1st. Automatic escalation to 25% by June 1st if no deal is reached. Markets reacted immediately. Silver jumped more than 5%, hitting $94.50 per ounce on Monday. By Tuesday, it reached an all-time high of $95.87. Gold surged past $4,700, also setting new records. Meanwhile, the S&P 500 sold off by 1.9% in midday trading. The Nasdaq plunged more than 2%. The Dow dropped significantly. In under 5 hours, more than $1 trillion in value was wiped out from the S&P 500. European markets saw sharp drops for the second consecutive day. Germany's DAX closed down 1%. Britain's FTSE 100 fell 0.7%. Italy's FTSE MIB slid 1.1%. The IC US dollar index dropped nearly 1%, on course for its worst day since April, when Trump first announced his reciprocal tariff agenda. This wasn't just market volatility. This was a structural shift in how investors view geopolitical risk. European Union ambassadors held emergency meetings Sunday, preparing retaliatory measures. French President Emmanuel Macron reportedly asked the EU to activate its anti-coercion instrument, colloquially known as a trade bazooka. EU capitals entered discussions to implement tariffs of up to $108 billion on American products. Analysts warned that Europe holds around $10 trillion worth of U.S. bonds and stocks, some of which sit with public sector funds, that could be weaponized in retaliation. Deutsche Bank warned that if Trump keeps up tariff threats over Greenland, European governments might start selling off their U.S. assets worth around $8 trillion. The results could lead to a weaker U.S. economy and dollar. In this environment, precious metals became the only safe haven. Silver's surge wasn't speculation. It was rational actors seeking protection from what the World Economic Forum in Davos identified as the most likely risk to present a material crisis on a global scale in 2026, geo-economic confrontation. When asked if he would be willing to use force to seize Greenland, Trump replied, no comment. That ambiguity, combined with the February 1st tariff deadline, created what analysts are calling the greatest transatlantic crisis in generations. Markets began pricing in scenarios that included the potential end of NATO, permanent fracturing of U.S.-European trade relations, and a fundamental realignment of global commerce. In this context, silver hitting $95 wasn't just about industrial demand or supply deficits. It was about systemic risk. Bond investors sold U.S. treasuries, driving up interest rates. Rising yields on treasuries typically translate into higher mortgage rates and interest on personal loans. The U.S. Mint briefly paused sales of silver collectors' coins to reprice them, as the 30% gain in January alone made inventory management impossible. And institutional investors, the sophisticated money that typically avoids volatility, poured into precious metals at record levels. Companies like Fresnillo and Endeavor Mining saw their valuations surge alongside gold. Mining stocks became the clear winners of what markets are now calling the Greenland Row. But this rally, dramatic as it appears, is just the surface, because beneath these headlines, a much larger structural shift is taking place. Silver's 147% rally in 2025, its 32% surge in January 2026, Trump's Greenland tariffs. Now, these are symptoms. The real story is what's happening beneath the surface. And it's something Wall Street doesn't want you to understand. For 6 consecutive years, the global silver market has been in structural deficit. That means demand has exceeded supply, not by small margins, but by massive amounts. In 2024 alone, the deficit reached 148.9 million ounces. Over 4 years, the cumulative shortfall totals 698 million ounces. You can't print physical silver, and the industrial demand driving these deficits isn't optional. Solar energy, electric vehicles, defense systems, artificial intelligence hardware, 5G networks. These aren't industries that can simply reduce silver consumption when prices rise. They're sectors receiving massive government investment and policy support across virtually every major economy. Industrial users consumed an estimated 60% of total global silver production in 2025. And that percentage is growing. This creates a demand profile we've never seen before in the silver market. Because historically, silver was primarily a monetary metal with some industrial applications. Today, it's a strategic industrial input essential to technologies that governments consider critical infrastructure. That's why China reclassified it as a strategic resource on January 1st. And here's where the paper market faces its endgame. The London Bullion Market Association's 2026 forecast survey, gathered from professional analysts and traders, predicts silver averaging $79.50 for the year. That represents a projected 98.8% increase from their 2025 forecast. Individual forecasts in the LBMA survey range from a low of $42 to a high of $165, with silver already trading at $95. 9 of the 26 forecasts have been breached. Most mainstream analysts now consider $100 per ounce not speculation, but a consequence of structural realities. But the real shift isn't just about price. It's about where price discovery happens. For decades, COMEX and the LBMA controlled global silver pricing through paper contracts. But when physical markets in Shanghai consistently trade at premiums of 12% to 13% above Western benchmarks, when Dubai and Tokyo dealers can't source metal below triple-digit prices, when lease rates hit 8%, the physical market is asserting price leadership over the paper market. This is the same transition that happened with lithium and rare earth markets when physical shortages emerged. Once physical delivery becomes the benchmark for price discovery, traditional futures exchanges lose control. And the consequences for paper silver holders could be severe. If COMEX is forced to declare cash settlement, if exchanges can't deliver physical metal to contract holders, that becomes what some analysts call game over for the paper market. The moment the world realizes the casino is empty, the paper price becomes a total work of fiction. Silver's transformation from monetary metal to strategic industrial resource means it now has 3 identities: industrial, monetary, strategic. Governments are accumulating it. Central banks in emerging markets are adding silver positions alongside gold. Industrial users are securing long-term supply contracts. And investors, seeing the structural deficits and geopolitical tensions, are converting paper claims to physical ownership. This isn't a rally that ends when sentiment shifts. This is a fundamental repricing of silver as both an industrial necessity and a monetary asset, driven by the hard limits of geology, energy, and geopolitics. Wall Street missed it at $30. They're still missing it at $95. The question isn't whether silver reaches $100. It's what happens to the paper market when physical supply becomes the only price that matters.